So we will now move on to the secondary market framework. Now in secondary market framework, similar to our financial market, you must have gone through the financial market frameworks. It is almost remain the same, that the government of India basically decide the policies. So the policy direction is always come from the Ministry of Finance, which is a part of government of India. Their major rule is that they should want that there is a discipline in the secondary market trading, and because of this discipline, more and more government agency as well as public should come, and they should raise their capital through this financial market, and at the same times investors should have a confidence to participate in the secondary market. And with this objective, Ministry of Finance come various policy directions. And in Ministry of Finance, there is a department called Department of Economic Affairs. Basically, they gives the micro level policies for participating in the capital market, or a banking related policy, or insurance related policies. So those things are come from the policy directions of from the Department of Economic Affairs. Now these directions are goes to the various regulatory or supervision agencies. So we have Reserve Bank of India, Securities Exchange Board of India, or insurance regulator, which is a RDAI. So these people then regulate their respective entities. Securities Exchange Board of India is very important role to play as far as secondary market, securities market transactions are considered, especially focusing on the equity sides. Then Reserve Bank of India mainly regulate the banking side, and they also regulate the government securities market and a money market instrument. So you must have seen the capital market and money market segregation in the financial market. So money market instruments and some part of capital market, which is a government securities market, come under Reserve Bank of India. Securities Exchange Board of India is main regulator for securities market. When I'm saying secondary market, it is mainly about the equity shares trading, or a derivatives trading in equity, or currency derivatives and so on, or trading on the stock exchange. Then IRDA basically regulate the insurance companies. So their regulations are drills down from Ministry of Finance. And then we have a various markets infrastructure who basically bring the service provider and investors together. So major market infrastructure providers are banks, depositories, stock exchange, and clearing corporations. We are going to see the role of each of these market infrastructure in detail in going forward. So stock exchange basically provide a trading platform where buyer and seller come and they do the trades. Clearing corporation does the clearing and settlement. So only trading execution is not important. The trade will have a end only if the proper settlement happen, where the funds are moved from buyer to the seller and securities are moved from the seller to the buyer. So this is done through the clearing corporation. Then the depositories is very important role to play. Now in India, we don't have a physical settlement because it is almost over now, and everything is settled in a demat form. Demat form is in an electronic form. So all these securities are available in electronic form with the depositories. So depositories keep all the securities in depository form, and when there is a transfer happen through a book entry, they move a security from one person to another person. So for example, when there is a trade happen between X and Y, and X sell the securities to Y, the depositories will debit the X account and credit the Y account, and the securities will move in electronic form from X to Y. So there is no actual physical movement. It is actually a paperless movement, and this is one of the important things which is happen in the secondary market development in India, that we have a paperless trading. These actually bring accuracy, safety, and speed in transfer of securities. And then comes the banks. Basically banks have major roles to play because they help in fund settlement. They also act as a depository participants. They also act as a custodian participant. So banks plays a major various roles in this market infrastructures. Then we have a market intermediaries who basically bring the investors and allow allow them to trade or facilitate them to trade on this market infrastructure, things like a stock exchange and clearing corporations. So we will start with first a stockbrokers. So stockbroker is a member of a stock exchange where any investor, if they want to buy or sell securities in the stock exchange, they will come through this stockbrokers. Then depository participants are a agent of a depository. So depository does not directly deal with the client. So if they want to provide any services, they provide these services to their agencies or agent, which is called depository participants. Then custodian or a designated depository participant, they are also a depository participants, but they also play an additional role where they are the custodian of the institutional, basically institutional investors. So they hold the securities and funds of institutional investors, and then they help in a settlement also. Now stockbroker basically is there for a stock exchange where they trade on behalf of their client based on the uh, request come from the client. And a clearing member is a member of a clearing corporations where they do a settlement of these trades which are happen on the stock exchanges. And clearing banks basically facilitate a transfer of funds and securities. So you know that in when a trade happens, there is a transfer of funds from one person to another. So it is from buyer to seller, and securities transfer from seller to buyer. So clearing bank help in the fund transfer part, and securities transfer happen through a depository participant and through depositories, so that the settlement will happen, and the clearing member is facilitate this for their investors, and the trading will take place at a stock exchange. So this is the way the whole trading will happen through all these market infrastructure and these market intermediaries. And the trading actually happens in a investor. So investor is the very very important players who are basically a lender, and they provide their funds and they get the securities. So we have a multiple type of investors. We have a foreign portfolio investors who called a fps, who are international investors who are allowed to invest in India. Then we have mutual funds, who is another big domestic financial institutions who are a very active player in the secondary market. Then we have a banks, then we have a life insurance companies, corporates, retail. In India, retail participation is very vast. Then there are other investor like NBFCs, big corporates, then family corporates. So those are the people who invest in this. So we will see these types of investor in detail in going forwards. So this is basically a framework of a secondary market. Now in secondary market, when we talks about, as I said, in secondary market is a place where basically buying and selling will happen between the buyer and seller, directly or indirectly. Okay, in any goods or services, including the securities product or a financial product. So where this trading can takes place, so it is on the trading venue. So these trading venues can be exchange traded or a screen based trading. So here they don't, the buyer and seller don't meet directly or don't talk to each other directly. Whatever trading is going to happen, it is happen on a screen, so basically on a stock exchange. So if you want to trade in equity, it is through a stock exchange. There are some asset classes like money market where on a neutral venue screen based trading can be possible, or you can do a over the counter trading. But over the counter trading is mainly happens in a corporate debentures or a corporate bonds, and to the some extent in the government of India securities. Or else if you considered about equity shares trading, then equity shares trading is related to only exchange traded market. Even other neutral screen based trading venues are also not allowed in case of equity trades. Then secondary market, we can now have a secondary market distinction based on the asset class as well as the nature of a product. Now when I am saying asset class, you have a equity market, you have a bond market or a fixed income securities market, or you can have a derivatives market. And in case of a nature, I can have a cash market or a derivatives market. So equity market is, as name suggests, you trade basically your equity shares, which are listed on the stock exchanges, and you can trade in that. And it is come purely under the guidelines of a Securities Exchange Board of India. It is also called a cash market. Why it is called cash market? Because here the settlement is happen once you buy or sell. You, if you are a buyer, you provide a cash and you get your securities. If you are a seller, you give your security and you receive the cash. So it is also called a cash market. But cash market is a general term, because cash market also used in case of trading in debenture or a government securities. And derivatives market, where you don't have a immediate settlement of funds, or you pay a funds and you receive the security. So it is basically a forward looking market. So we will see a derivatives in little bit in few slides. So we have a equity or a cash market. So we have a this debt market. Now debt market consists of government securities and corporate bond. Why there is a segregation of government securities and corporate bond? Because government securities are mainly governed by Reserve Bank of India, because it is uh, Reserve Bank of India looks after the primary market and secondary market of government securities. And corporate bonds, debentures come under the purview of SEBI. So SEBI looks after primary market, secondary market trading of corporate bonds, debenture, as well as equity shares. And that is why these segregations. In addition to that, all the secondary market related guidelines and the structure of the government securities market and the structure of a corporate bond market are totally different. We will see that in next few slides. We have just touched upon that. And then last one is a derivatives market, where you trade in some underlying, or you derive the price of some underlying, like equity shares or equity indices, or a currency pairs like USD INR, or say Euro INR, or interest rate instruments, or interest rate directly, or a commodity, or a credit, like or credit swaps, etc. So this is a derivative market. So our major focus in today's session is trading on exchange and with regards to equity shares. So we will touch upon other things, but a little bit, but the major focus will be on the exchange traded market with focusing on the equity shares. So derivatives market, when I am talking about derivatives market, some people think that derivatives market is mainly for a hedging purpose, but there are also view that a derivatives market can be considered as an investment also, because the rule of investment is that you take a risk and you get a return. In derivatives market, the risk is high and return is also possibly can be a high, but it is for a very short period. So that is why derivatives market also can be a part of secondary market from the investment side. So now we will next move on to the different kinds of assets which are traded on the secondary market. So here again I am focusing mainly on the exchange traded secondary market. So equity shares, everybody know about equity shares, that it is also called ordinary shares, where you get the ownership of that company, and you are allowed to get a dividends as your return. However, when you invest in the equity shares, the return are high. At the same time, the risk is also on a higher side, because in case of profit, you are the last person who, or the holder will be the last person who will going to receive the dividend. And in case of liquidation of that company also, he will be the last person who will get the residual amount if there is any leftover. So it is a high risk, high return asset class. Then you have a preference shares. Again, there are various kinds of preference shares are available. Some have similar kind of nature, like a fixed income securities, which is bonds and debentures and government securities, where you get a fixed return of say 5% interest or a 7% interest, like a fixed deposit. However, these are also tradable in the market. There are various types of things are available. Bonds and debentures are basically issued by the corporates, and government securities are issued by the central government and state government. The state government and central government, since issue and they guaranteed this bonds, they are basically called a credit risk free bonds. Then another product is exchange traded funds. Basically, exchange traded funds track the indices and other commodities, or a portfolio of few commodities, and it is trade on the exchange. So exchange traded funds basically have features of equity shares, as it trade on the like equity shares on the secondary market. And it is also have the feature of mutual fund, because the NAV or the asset uh, amount or a price of exchange traded funds are decided uh, through the underlying securities. Then some of the mutual fund scheme, especially closed-ended schemes, are traded in the secondary markets. Then there are some new instruments which have come in the market recently, like REITs and InvITs. So REITs, it's basically a real estate investment trust, where they invest in the commercial real estates, and they issue a publicly or privately some instruments, and those instruments are get also traded on this the secondary market. And InvITs basically invest in the infrastructure securities, and again it can be a public or a private placement through which the issuance can happen, and those issues then get traded on the secondary market. So these are the new assets class which are there in the market. Then Indian depository receipts, uh, foreign companies cannot come and list their securities in the Indian markets. It is prohibited. So if any foreign company wants to raise fund in India in Indian rupees, they can use this Indian depository receipts routes, where they will issue equity shares, and then any designated depository participants or custodian can issue a depository receipt against these underlying equity shares, and those IDR will get listed on the exchange and allowed to trade. Then warrants, basically a holder of a warrants is eligible to get equity shares in a future date at a certain future price. And the last one is the rights entitlement, which is a very recent product which is there. So this is a very interesting product. You must have learned about the right issue in a primary market. So in case of right issues, what happen? The existing shareholder only allowed to invest or go and participate in the rights of that company. But however, suppose any issuer or any investor who is holding the share does not want to invest in the rights, so he can sell his right to some other person, and this selling of rights can happen through right entitlement. So this is again an interesting product where you are selling your rights of participating in the rights issue of that company to a different participants, and this trading is also available in the secondary markets. So these are the various kinds of assets are there in the secondary market. Again, I am reiterating that our focus will be on the equity shares trading on the stock exchanges.